also connected to some journalists via video conferencing. So I'd like to ask them, if they ask a question, to put on their cameras and their microphones. And with that, I'd like to hand over to President Lagarde, please.
Thank you very much, and good day to all of you. Today, the Vice President and I are delighted to welcome you to our press conference. The Governing Council today decided to lower the three key ECB interest rates by 25 basis points. Based on our updated assessment of the inflation outlook, the dynamics of underlying inflation and the strength of monetary policy transmission, it is now appropriate to moderate the degree of monetary policy restriction after 9 months of holding rates steady. Since our meeting in September 23, inflation has fallen by more than 2.5 percentage points, and the inflation outlook has improved markedly. Underlying inflation has also eased, reinforcing the signs that price pressures have weakened and inflation expectations have declined at all horizons. Monetary policy has kept financing conditions restrictive. By dampening demand and keeping inflation expectations well anchored, this has made a major contribution to bringing inflation back down. At the same time, despite the progress over recent quarters, domestic price pressures remain strong as wage growth is elevated and inflation is likely to stay above target well into next year. The latest Eurosystem staff projections for both headline and core inflation has been revised up for 2024 and 2025 compared with the March projections. Staff now see headline inflation averaging 2.5% in 24, 2.2% in 25, and 1.9% in 26. For inflation excluding energy and food, staff project an average of 2.8% in 24, 2.2% in 25, and 2% in 26. Economic growth is expected to pick up to 0.9% in 2024, 1.4% in 2025, and 1.6% in 2026. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We will keep policy rates sufficiently restrictive for as long as necessary to achieve this aim. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, our interest rate decision will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The Governing Council today also confirmed that it will reduce the Eurosystem's holdings of securities under the Pandemic Emergency Purchase Programme by 7.5 billion per month on average over the second half of the year. The modalities for reducing the PEP holdings will be broadly in line with those followed under the Asset Purchase Programme. The decisions taken today are set out in a press release available on our website, and I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. So looking at the economic activity. After 5 quarters of stagnation, the euro area economy grew by 0.3% over the first quarter of 24. The services sector is expanding, and manufacturing is showing signs of stabilization at low levels. We expect the economy to continue to recover as higher wages and improved terms of trade push up real incomes. Stronger exports should also support growth over the coming quarters as global demand for goods and services rises. Finally, monetary policy should exert less of a drag on demand over time. Employment rose by 0.3% in the first quarter of this year, with around 500,000 new jobs created, and surveys point to continued job growth in the near term. The unemployment rate edged down to 6.4% in April, its lowest level since the start of the euro. Companies are still posting many job vacancies, though slightly fewer than before. National fiscal and structural policies should aim at making the economy more productive and competitive, which would help to raise potential growth and reduce price pressures in the medium term. An effective, speedy, and full implementation of the Next Generation EU programme, progress towards capital market union, and the completion of banking union, and a strengthening of the single market would help foster innovation and increase investment in the green and digital transitions. Implementing the EU's revised economic governance framework fully and without delay will help governments bring down budget deficits and debt ratios on a sustained basis. Looking at inflation now. Annual inflation rose to 2.6% in May from 2.4% in April, according to Eurostat's flash estimate. Food price inflation declined to 2.6%. Energy price inflation increased to 0.03% after recording negative annual rates for a year. Goods price inflation continued to decrease in May to 0.8%. By contrast, services price inflation rose markedly to 4.1% from 3.7% in April. Most measures of underlying inflation declined further in April, the last month for which data are available, confirming the picture of gradually diminishing price pressures. However, domestic inflation remains high. Wages are still rising at an elevated pace, making up for the past inflation surge. Owing to the staggered nature of the wage adjustment process and the important role of one-off payments, labour costs will likely fluctuate over the near term, as seen in the pickup in negotiated wages in the first quarter. At the same time, forward-looking indicators signal that wage growth will moderate over the course of the year. Profits are absorbing part of the pronounced rise in unit labour costs, which reduces its inflationary effects. Inflation is expected to fluctuate around current levels for the rest of the year, including due to energy-related base effects, and it is then expected to decline towards our target over the second half of next year, owing to weaker growth in labour costs, the unfolding effects of our restrictive monetary policy, and the fading impact of the energy crisis and the pandemic. Measures of longer-term inflation expectations have remained broadly stable, with most standing at around 2%. Turning now to our risk assessment. The risks to economic growth are balanced in the near term, but remain tilted to the downside over the medium term. A weaker world economy or an escalation in trade tensions between major economies would weigh on euro area growth. Russia's unjustified war against Ukraine and the tragic conflict in the Middle East are major sources of geopolitical risk. This may result in firms and households becoming less confident about the future and global trade being disrupted. Growth could also be lower if the effects of monetary policy turn out stronger than expected. Growth could be higher if inflation comes down more quickly than expected and rising confidence and real incomes mean that spending increases by more than anticipated, or if the world economy grows more strongly than expected. Inflation could turn out higher than anticipated if wages or profits increase by more than expected. Upside risks to inflation also stem from the heightened geopolitical tensions, which could push energy prices and freight costs higher in the near term and disrupt global trade. Moreover, extreme weather events and the unfolding climate crisis more broadly could drive up food prices. By contrast, inflation may surprise on the downside if monetary policy dampens demand more than expected, or if the economic environment in the rest of the world worsens unexpectedly. So, our financial and monetary conditions review. Market interest rates have risen since our April meeting. Financing costs have plateaued at restricted levels as our past policy rate increases have worked their way through the financial system. The average interest rates on new loans to firms and on new mortgages were unchanged in April at 5.2% and 3.8% respectively. Credit dynamics remain weak. Bank lending to firms grew at an annual rate of 0.3% in April, down slightly from the previous month. Loans to households continued to grow at 0.2% on an annual basis. The annual growth in broad money, as measured by M3, rose to 1.3% in April from 0.9% in March. In line with our monetary policy strategy, the Governing Council thoroughly assessed the links between monetary policy and financial stability. Euro area banks remain resilient. The improving economic outlook has fostered financial stability, but heightened geopolitical risks cloud the horizon. An unexpected tightening of global financing conditions could prompt a repricing of financial and non-financial assets with negative effects on the wider economy. Macroprudential policy remains the first line of defense against the build-up of financial vulnerabilities. The measures that are currently in place or will soon take effect are helping to keep the financial system resilient. In conclusion, the Governing Council today decided to lower the three key ECB interest rates by 25 basis points. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. We will keep policy rates sufficiently restrictive for as long as necessary to achieve that aim. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
Thank you, Madame Lagarde. And the first question goes to Annette Weisbach of CNBC. Annette, please.
Thank you very much. President Lagarde, thank you very much for taking my question. My first one would be like a general one, because clearly cutting rates at the same time with hiking in the inflation forecast needs perhaps a little bit more explanation. and also the question whether you perhaps pre-committed yourself too early to that cut. The second one is, the market currently is expecting some 65 basis points in cut during the course of this year. Is the market right or about right? Thank you.
Well, thank you so much for your opening question. And let me take this opportunity to give you a bit of an opening answer and tell you what we did this morning and what happened as a preamble to this morning's decision. But let me first tell you that we started our meeting this morning by paying tribute to the many men and women who sacrificed their lives on the beach of Normandy today, which is the 80th anniversary of D-Day. And we paid tribute to those sacrifices and those of many others because it enabled us to build what we have built, to disagree in a very civilized way, to have very harmonious and congenial decisions amongst 20 different nationals representing their respective national central banks amongst our governing council. And it was perfectly appropriate and fitting to do so. Then we decided to cut. And we did so because overall, our confidence in the path ahead, because we have to be forward-looking, has been increasing over the last months. So let me explain to you why our confidence has increased in the path ahead. And I will take you back a little bit, because this is, after all, the first time in many years that we make that kind of decision. And these things do not happen in a vacuum. So I'll take you back a little bit to our monetary policy cycle to remind you that we have had 2 successive phases and we have made that decision. So the first phase, as you will remember, was a phase of very robust and rapid tightening. We tightened by 450 basis points between July 22 and September 23. Then we moved into a phase of holding from September 23 up until today. And if I look back, and we look back at those phases, during each of those phases, we divided inflation by half. So if you look at the peak of inflation, October 22, we were at 10.6, double-digit inflation on average. Now fast forward, September 23, we are at 5.2. Fast forward to today, we are at 2.6. So at each and every step of the way, when we reassess and decided to move in a different direction, we had halved inflation. I think the second element that we took very much into account was the reliability and the strength of our projections. And there is one particular line of projections which to many of us was relevant. If you look at Q4 25 projections, you look at September, you look at December, you look at March, you look at June, there's a variation between those projections of 0.1. So it's either 2 or 1.9 or 2 or 1.9 or 2. And it's on the basis of this reliability and solidity and robustness of those projections that we have made that decision to actually cut. But we have done that, and I'm sure that you will be asking, what about next time? Yeah. And I will invariably tell you the same thing, which is what is included in the monetary policy statement. We shall be data dependent, and we shall decide meeting by meeting. But to say that is probably not enough. And how we collect data matters, but what is also more important is how do we analyze the data? And I'm not only specifically pointing at one set of data, all the data that we get. We're looking at it under the prism of our 3 criteria. And you will have noticed that I have repeated 3 times, I think, in this monetary policy statement, the 3 criteria, which are the inflation outlook on the basis of the financial and economic data that we collect. It's the underlying inflation, and it's the transmission of monetary policy. So it's under the prism of these 3 criteria that we analyze all the data that we have available. And we need to have those data. We need to have enough of those data to make a relevant and appropriate analysis that took us this time around to this decision. Thank you. What was your second question? Oh, well, you know, markets do what markets have to do, and we do what we have to do.
Thank you, Madame Lagarde. The next question goes to Valentina Zaar of Reuters. Valentina, please. Wait, there's a microphone.
So where are you?
Yeah, hello.
Hello.
Thank you for taking my question. Because you just mentioned that you need enough data to take your decisions, and back in March you said that you will know a little more by April and a lot more by June. Mm-hmm. Are we in a similar situation where only a little more will be known by the next meeting and a lot more by the one after that? And more broadly on this topic, some argue that some of your meetings coincide with the release of key indicators, and therefore that those policy meetings are more important. What do you think of this view? Do you share it? Thank you.
Well, thank you very much. You are correct that there is not perfect synchronicity between our meetings and our decisions and the publication of particular data. I'm thinking of one particular data that will come for publication tomorrow, which is the compensation per employee for Q1, which obviously is relevant because we look very carefully at wages from all possible angles of analysis, and CPE is a relevant point. It's not the only one. Wages is an important field of data that we need to analyze, but CPE is one of them, and it's only being published tomorrow. So what we try to do, that's just to take you a little bit behind the scene, is we collect as many data as is available, and at the moment we have about 15 countries or so, and a very large portion of the euro area economy, and we calculate what is the likelihood of that number to better assess and test our resolve, and that's what we have to do. And there is no perfect synchronicity between the date of publication, which are set, and the date of our monetary policy meetings, which are also set, and they're not, you know, coinciding necessarily all the time. You also asked me the question of, you know, what kind of data are we talking about? First of all, it is data. Second, it is enough data so that the analysis that we conduct under the 3 criteria that I have mentioned can actually be relevant. So I'm not going to tell you today, nor at any point in time, until much later on in the summer, whether we do this now or whether we do something else at another point in time. The only thing I'm telling you is that we need sufficient data, and data comes in gradually over the course of time, sufficient data to actually corroborate the view that we have that the disinflationary path is being confirmed and warrants further decisions.
Thank you, Madame Lagarde. And the next question goes to Mark Schroers of Bloomberg. Mark, please.
Yes, thanks for taking my questions. You mentioned the different phases the ECB went through with the holding phase recently. And with the cut today, are we entering the dialing back phase you mentioned in your March speech at the ECB Watchers Conference? So should we expect a series of rate cuts, or could it also be a case that this one is a one and done? And the second one, your chief economist recently said that that interest rates need to remain restrictive this year, but that the ECB wants to remove the top level of restriction. What does that mean? How much can the ECB cut interest rates before they are no longer sufficiently restrictive? Thanks.
Well, first of all, thank you for reading my speech, or for having been in the room. That was the Watcher's speech, in which, you know, in a sort of perspective, but also, I wouldn't elevate myself to that level, but in a vaguely academic way, I tentatively analyzed the phases that we had gone through and anticipated what could come next. Are we today moving into a dialing back phase? I wouldn't volunteer that, because as I said, we are making a decision on the basis of the confidence that we have that we are on a path. But we will need, at each and every point in time, in the course of the next few months, we will need data and more data and analysis of those data to constantly confirm that we are on this disinflationary path. So we know the destination. We know the direction that we are taking. We know the methodology that we will apply. We know the volume of multiple data that we should be receiving and that will accumulate and corroborate, hopefully. But I cannot confirm that it is the dialing process that is underway. There's a strong likelihood, but it will be data dependent. And what is very uncertain is the speed at which we travel and the time that it will take. Again, this will be determined by the data that we receive. Now, you asked me about the restrictiveness. We are currently restrictive, even after this 25 basis point cuts, as you well know. And we were today more restrictive in real interest rate terms than we were back in September. So what we're doing here, as indicated by our chief economist, Philip Lane, is removing a degree of restriction. We are moderating the level of restriction that applies. That's exactly what we are doing at the moment. How long will that take? As I said, I cannot tell you now. At what speed will it happen? I cannot tell you now either. It will be delivered by the data. I'm sure that you will hear some of my excellent colleagues take their view. You know, it will take such time. It will move at such speed. I would caution against any such conclusion for one simple reason. We know the path we are on, but we also know that there will be other bumps on the road. I said last time when we were together that we were traveling that journey on a road that was downward towards the 2%, but that there would be bumps on the road. There are bumps that we can more or less predict, that we can anticipate. I mean, base effects are, you know, case in point. But there are bumps on the road that can come as a surprise. There are bumps on the road that we can anticipate, but the magnitude of which we are not totally confident about. You know, wages is another case in point. Depending on which country you look at, depending on what collective agreement you look at, there can be a massive amount of catching up. Front-loaded agreement to increase wages, and then it fades away. So all these things have idiosyncratic characteristics that will actually either increase, reduce, or deliver the same level of bumps that we are considering. But we know it's going to be a bumpy road, let's face it. The next few months will continue to be bumpy. We know that.
The next question goes to Martin Arnold of the Financial Times. Martin, please.
Thank you very much. President Lagarde, two questions, if I may. Firstly, you talked about the importance of the data, and you had stressed before this meeting the importance of the first quarter data, and particularly the wage data, and that you'd hoped to see a moderation there. You didn't see a moderation. You saw an acceleration in the wage data back to almost a record high. So can you explain why what you saw was still enough to allow you to cut? And secondly, you've predicted that there will be a moderation in wages in the Eurozone later this year. Do you need to see that moderation actually happen before you can cut again? Thank you.
Thank you very much for your two questions. So, again, what we wanted before making that decision was collectively to increase our confidence level that the path ahead was on its disinflationary rhythm that we needed in order to make our decision. And to do that, we looked back at the last time we decided to hold, which was in September, and we assessed the journey from September 23 up until now. And as I just said in the previous answer, there are bumps on this road that we are traveling with more confidence that the disinflationary path is actually materializing. We will be looking at multiple data, not only wages. But you're quite right to take me back to wages, because wages matter enormously in a tight labor market when it comes to services. And we know that services are an important element of the items in the index, which have been rising. The last service number that we had was 3.7. That was back in April, went up to 4.1 in May, after a series of 4s in March, February, January before that. And what's at the root of this increase in service prices is predominantly wages. So what happened to wages in the last few months? First of all, there has been divergence between countries. So we really looked under the bonnet of wages, and we looked under the bonnet of countries, because some of the decisions that were made were country-specific. I'll take one example, Germany. Germany, because in Germany, most of those collective agreements are negotiated on a triannual, every 3 years. And to give you a more specific example, public service agreement actually happened in 24 and has now compensated the lost purchasing power since 21, which is when the last agreement was reached in the public service. So you can imagine that an agreement that is cut in 24 that covers 21, 22, 23 is obviously going to be very sizable, and it was in the 12%. We have the same, exactly the same story for the retail sector, which is quite significant, where again an agreement has been reached now, which is an ovation compared with 3 years ago. So then we have to analyze what's underneath. There is the catching up, front-loading. Is it also accounting for future years? It's not too clear in the public service, but it's very clear in the retail sector agreement. So that leads us to assume that wages will continue to remain elevated. If you look at negotiated wages, Q1 they were at 4.7. If you look at compensation per employee based on what we can calculate on the basis of 15 countries, 4.7%. Compared with 4.5 for negotiated wage in Q4, 4.7, same stabilization on the compensation per employee in Q4. So we have elevated levels, tentative stabilization, and then we look at our third indicator, which is the wage tracker, which includes 7 of the euro area countries, including the largest one. So we cover a very large chunk of the European economic activity and labor markets. And what that wage tracker tells us is that while still elevated for the stock of agreement and various accords that are recorded by the wage tracker, this is still elevated, that's the stock. When we look at the flow, what is coming in now, we are seeing a decline in the wage growth. So it's not an easy matter, wages, because it is peculiar. It includes also lots and lots of elements. You have the catching up. You have what we call the wage drift, which includes a lot of very specific items, including social security contributions, including overtime, including differential between low and high paid employees and all the rest of it. So we try to really combine and confront all this data, all this information, to analyze it, and that leads us to the conclusion that while still elevated, no question about that, we are seeing those wages on a declining path, and that will particularly be the case in 25, because the 12% decided in 24 are not going to be producing the same impact in 25. And that is, I think, even, comforted by the fact that this particular projection exercise is checked and cross-checked and produced jointly by the staff of the ECB and the staff of the national central banks, which have really their fingers on the pulse of those collective agreement and compensation per employees. The second part of your question was, how long will it take, or how much more do you see? We are going to look at data as they come in. On wages and profits, it's not a monthly exercise. It comes at a different interval, and we will have to, test our assumption of declining wages towards the end of 24 and seriously less elevated wages in 25 in the course of the next few weeks and months.
Thank you, President. And the next question goes to Silvia Berzoni of the Italian news channel Class CNBC. Silvia, please.
Thank you very much. Good afternoon, President. Good afternoon, Vice President. So following up on a previous question, given that you will need data and more data, do you think that projection route meeting of the Governing Council could be more suitable for interest rate decision, given that you will have also forecasts available? And the second question is, how divided is the Governing Council over the future path of interest rate? A third one would be if it was a unanimous decision today, but thank you very much.
You can't go more than two, but okay, I'll take the three. So I'll start with the third one. Was it a unanimous decision? Yes, but for one governor. Okay, so I leave it to your sagacity to identify who it is. Were we divided as far as the path ahead is concerned? We were all absolutely united to agree that our path would be data dependent, that we would decide meeting by meeting, and there was absolutely no dissent on that front. We also confirmed that our criteria, the three that I have mentioned, inflation outlook, underlying inflation, strength of monetary policy transmission, would continue to drive our analysis of data going forward. I can't remember what your first question was. You'll have to remind me.
It was about, given that you need data and more data, do you think that projection round meetings of the Governing Council could be more suitable for interest rate decision, given that you will have also forecasts available? Thank you.
Well, first of all, those are not our projection. Those are the projections of staff. And it's obvious that projections produced by staff on a regular basis are very informative, go deep into the data that we receive, analyze at length, produces scenarios analysis, sensitivity analysis, and that this is very helpful for us to make decisions. But that doesn't mean to say, and I would not say that now, that we would only decide at the time of projection meetings, because we have to be data dependent at all times. But obviously we have more data when we have projection meetings.
Thank you, Madame Lagarde. And the next question goes to Klaus-Rainer Jackisch of the HR Television. Klaus-Rainer, please.
Thank you. Good afternoon, Mrs. President. Thank you for taking my questions. Some months ago, you were standing at this location promising the people in the Eurozone that the Governing Council is determined to break the neck of inflation. Would you say that the neck is being broken? One could have some doubts seeing the current data and also your projections. So how is the view on that? And the second, connected with this, we have heard a lot of criticism already before this session and a lot of doubts whether this rate cut is really at the right point, because some people are doubting that inflation indeed is on the right track. We now have started the voting for the European Parliament, and as you know, there's a lot of criticism of European institutions. Is it really the right point of time to take these decisions when some people may now get the impression that the ECB doesn't take the combat of inflation seriously enough anymore? Thank you.
Well, thank you for your question, and I can assure you that we take the fight against inflation extremely seriously. And if there is one thing that I have learned in this job is that we have to be persistent, we have to be determined, we have to be data dependent, but we cannot give up on the objective. And our objective is to tame inflation and to bring prices back, to bring inflation back to 2% in the medium term. So let there be no doubt about our determination to tame inflation and to restore price stability. And I will mention 3 numbers for you, because I think that, you know, in my sleepless nights, I try to have that in the back of my mind. And there's that little voice that says, carry on, carry on. October 22, inflation on average in the euro area, 10.6%. September 23, less than a year later, inflation, 5.2%. That's the reading of August, because we made the decision in September. Today, 2.6%. Each and every step of the way, we divided inflation by 2. I don't want to divide the next inflation by 2, because if we divide 2.6 by 2, we have 1.3. Our commitment is 2%. We don't want to go there, no. But as is very clearly stated in the monetary policy statement, we are moderating our restrictive stance. It is still restrictive. And we will continue to be restrictive as long as necessary to bring inflation to 2% in a timely manner. Have no doubt about that. Thank you.
Thank you. And the next question goes to Nuria Salobray Fuenteville of El País over there.
Hello, thank you. What do you think about the level of concentration in Spanish banks, and what could happen with this if BBVA is successful in his offer for Sabadell? It could be a problem for competence or maybe for the financial stability. Thank you.
Thank you so much. There's somebody far more competent than me on that one. Vice President.
Well, good afternoon. Well, I think that we have been crystal clear with respect to the, this kind of situations. We do not elaborate, we do not comment on transactions, deals that have not been finalized yet. Our party line has been quite clear. We will make an assessment about any kind of transaction that implies mergers, the purchase of stakes of banks. But, this assessment will be based on prudential and solvency issues. That's what I can say now. And, well, we will see, the outcome at the end.
Thank you, Vice President. And the next question goes to Santi Pignol of M&I. Santi, please. Here.
Good afternoon, President Lagarde.
Good afternoon.
So, my question is, in the moment that we are right now, can you be now more clear in the assumption where the neutral rate is, they are currently? And the second question, the governor that wasn't on board on the cut was looking for a bigger cut or an unchanged rate cut, like keeping it on hold? And what was the argument, if you can tell us something about?
The answer to that question is no, because that's the privacy of the deliberation to the extent that they relate to one particular person. But I'm sure you will identify that person quickly and will be able to get that information from him. Now, more seriously, on the neutral rate, you know that I have refrained systematically from erring towards a particular number or identifying a neutral rate or a range around the neutral rate. I will simply say this, is that if it has increased compared to where it was before COVID, we also know that we are far away from neutral rate now. And by moving from 4% to 3.75% on the DFR, we are not close to the neutral rate. So we still have a way to go.
Thank you very much. And the next question goes to the lady in the pink. In the pink jacket, please.
I won a lottery, so thank you. I'm Silvana Skočajić. I'm coming from Croatia, the latest member of Eurozone. So welcome. I was wondering, since we are still having the highest rate of inflation in May, 4.3, behind the Belgian, second. But on the other side, we have the biggest growth in Eurozone. In last quarter, it's 3.9. So are we in risk because of this decision of today? And what do you expect? How it's hard to really make a decision that affects all these countries in Eurozone, and you expect, to inflation to really go down? Thank you.
Well, first of all, welcome to this circle, and we're very happy that Croatia has joined and has extended the circle to 20. Your question was, similar to the ones that we had when some of the Baltic states, in particular, were cruising at a much higher interest rates than the average in the euro area, and it's the whole issue of divergences that we have amongst ourselves, because we have different fundamentals, because we have different heritage, because of different structural rigidities as well. And we have, from an ECB standpoint, we have to look at euro area data, and we cannot go down into the specificities. We have to be mindful of the divergence, and we do publish. We will be publishing soon, actually, a convergence report that will identify these divergences and how close countries are getting. We very much believe that inflation will come down. We will continue this disinflationary process, and that will apply to all member states. But again, the pace, consistency between countries is always going to be an issue. I hope it's not too big an issue, and obviously to have growth and strong demand has its disadvantages as well as benefits. Thank you.
Thank you. And the last question today goes to Jan Malin of Plato, here in the front row.
Hello, Madame Lagarde. Thank you for the opportunity. The French President Emmanuel Macron has proposed to extend the mandate of the ECB to economic growth and climate protection. What's your view on that? And I would be curious on your view also on the proposal to publish dot plot from Isabel Schnabel. Would you support this idea or not? Thank you.
Well, thank you for your two questions. At the European Central Bank, we have a very clear mandate, and that mandate is enshrined in the treaty, and that mandate is a focus on delivering price stability. We believe that that price stability mandate provides solid guideposts and boundaries for our monetary policy strategy. We don't see a need, nor do we have the capacity or the competence to change that. I would also observe that providing price stability and giving predictability to sustainable investment is certainly one of the various contributions that we can make in relation to the fight against climate change. We have different set of actions, from risk management to better modeling and including climate change risks and mitigation measures in our work. But providing price stability is certainly a good way to tell those investors in sustainable projects, you have price stability, and the ECB will be here to guarantee that prices are stable. There's nothing like, waves of inflation to discourage investment that require a long-term perspective and a later return on investment. The dot plot mechanism is an interesting concept, and I think I would leave it at that.
That brings our press conference to an end. Thank you very much for following. Our next press conference.
All right. Good show. Good show. Hey, is anyone going to meet me in St. Louis? You want to meet me in St. Louis? You guys want to get together for a cigar and a cocktail, maybe dinner? In St. Louis, I have 2 days of meetings at the St. Louis Fed about 2 weeks from now. You guys want to meet up on Monday evening? I'll be there by my lonesome anyway, so why don't we meet up for a cocktail and a cigar? Is that a maybe from anybody? Is anybody in near St. Louis, Missouri? Maybe a 2 or 3 hour drive? Are you that close? No? Jim's a maybe. Detroit's more than a couple hours, huh? It's going to be a quick one, Bernd. Quick and easy. I fly in Monday morning and then do all day meetings, and then I have Tuesday all day meetings, and then I fly out Tuesday night. Ooh, 8 hours. Don't you have a plane though? Can't you jump in a Cessna and get there in 2.5? I'd rather die than fly a Cessna. Yeah. I thought you had a collection of planes. Like, I have this plane and that plane. I don't even know which plane I would take. But yeah, 14 hours, too far. No, it's just if someone happened to be there, like if it was no big deal, yeah, we should have a cocktail and a cigar. But don't make a big deal out of it. Unless you want to see the Fed, like I said, I don't know if I can get you past security. I don't know the protocol. But at quick glance, it seems to be there's a really cool museum. So I'll probably try to see the museum as well. I know when I worked in San Francisco as a VC, our office was right next to the San Francisco Fed, and they also had a museum. Oh, you did, yeah, don't have it anymore? Yeah, too bad. That'd be a perfect flight. Really, huh? Straight south. Yeah, too bad. Yeah, don't drive 8 hours each way. Yeah, don't do that. Yeah, there'll be opportunities. Nobody that close, huh? Nobody in St. Louis. Yeah, well, I guess what I'll do is I'll find a good rib place. And then I'll find a good jazz place. And I already found a great cigar club. Oh, my God. You're like, dang, look at this place. So, yeah, I'll figure that out. Well, I just want to make myself available. If you were there, be a great opportunity to shake your hand. By the way, Europeans, that means shaking hands is like kissing on the cheeks. Oh, yeah. Too far from Texas. Yeah, well, you wouldn't eat the St. Louis ribs anyways if you're a Texan. Yeah. All right. Well, anyways, I'll keep that in mind. I'll keep asking over the next week or so. Maybe we'll find one or two people, right? Hey, I didn't say pork, but I guess what do they eat? Pork ribs? Yeah, beef only, sir. Yeah. Could be beef ribs. All right, so the ECB cut. Everything's good now, everybody. Europe is saved. Just the comment here, having seen what various chats and stuff. Is it a hawkish cut? Is it a dovish cut? Don't think of it that way at all, because it doesn't make sense. That's and you get this in the media all the time, so it's not your fault. Normally, a central bank cuts because they're dovish, the economy is crashing, and they're trying to save the economy. That's not what's happening here. What they're doing is normalizing. They've been restrictive for, I think it's 15 months. And the rule of thumb is it takes 12 to 18 months for rate hikes to take effect. So we're right in the zone. And goods inflation came down, as Christine Lagarde pointed out. But that has nothing to do with the ECB. It has nothing to do with the Fed. They didn't do any of that. That was the supply chain. That's normalization. But in Europe, they happen to be in a recession. You're like, wait. They're not in recession. They have positive GDP. Talk to the manufacturing sector. And when you're talking about Germany, they're a manufacturing and exporting economy. And it's the biggest economy in Europe. And they are definitely in recession. So they're at this point where headline inflation is low. And it looks low. It's lower than the United States. Well, again, two comments. Goods inflation are down, but they still have high wage inflation. They still have services inflation. And the reason they're at 2-something and not 3-something like the United States is they don't count housing. But we know there's two sticky inflations in the world right now. Wage inflation and housing. But they don't even count housing. So that's why they're lower. So anyway, so they're going to, or they have cut. But don't think, like someone said, well, they cut, but they're hawkish. No, what they're doing is they're normalizing. And the normalization process is moving back toward R star. Oh my God, now we got to do R star. I don't think I'm going to do R star today, but think of a business cycle. You have potential GDP, Y star, and actual GDP, Y. Y is nominal GDP. Okay, and then there's some sort of interest rate that'll influence the economy moving toward potential GDP if there's too much inflation, or back up to potential GDP if there's low productivity. And that's called a productivity gap. And you close that by so there's this magical interest rate to get productivity to where you kind of need it to be. So they realize that they've killed manufacturing, which they don't really want to do. Goods inflation is down, and then wages will take another 18 months or maybe even more. So they can still achieve that by lowering interest rates closer to R star, which keep, you know, and they want to keep the economy growing above Y star. So there's that kind of there's now we're caught between the two stars. Potential GDP and the neutral rate of inflation, right? So anyway, so they want to they brought down what they can bring down, and now the rest is a waiting game, but they don't want to kill the patient. They need to cure the cancer, but they don't want to kill the patient. Okay? So now they're making this adjustment where moving, you know, from 4 something down to 3 something is still restrictive. They're not doing it to save the economy, but they've, you know, they've done what they've needed to do, and now they need more time. So don't think it as a hawkish, like they have to cut, but there's still lots of inflation. Yes. Or they have to cut because manufacturing's in the toilet. Yes. Just think of it as normalization. And you're not going to get that in the media. You're not going to get that on TV. You're not going to get that kind of explanation. But I don't think you'll get that anywhere else. But the thing is, they're economists, and this is what they talk about. And so think of it as simply a normalization, that interest rates have been unusually high for a reason. Much of the goals of that policy have been achieved, and now they can lower interest rates but still be chipping away at inflation without killing the patient. Okay? Okay? Like I heard that there's new therapy now for PTSD, post-traumatic stress disorder. It's ecstasy. Have you read this study? They're giving ecstasy now to vets. I'm like, that's interesting. There was a couple of times when I was a young man that I may or may not. And, well, it's interesting because, well, it does play interesting games with your mind, and it does make you happy. Very happy. Okay, well, that's interesting. All right, so for someone under emotional distress, I could see how for a moment in time that would make a difference. I don't know how it works out as therapy, but I guess, you know, they're working on it, right? Now, the thing is, if one pill makes you happy, 5 pills make you OD, and 10 pills kill you. So if this was like, what do you do to help the economy? Too much is bad. Okay? Ketamine? I don't even know what that is. Okay? Jay, go to fxstreet.com. And I wrote a whole article, I don't know, 8 years ago about that. Excruciating detail. Let's see if I can find it. Hang on. fxstreet.com. I'll do a search and see if I can find it. How to prepare for employment situation report. Wayne McDonald. All right, let's see if we can get it. How to prepare for and I think and predict Wow, this is interesting. There's articles about me writing the article. What is this? Non-farm payrolls, how to prepare for and trade the employment situation report, Wayne McDonald. But that's not the article. That's not FX Street. ADP. They mentioned it in the other one. That's weird. All right, well, I'll have to pull up the one that's not FX Street. Where did it go? Because that's... Oh. So this is like an illegal copy. Look at... We like to thank these people, but we also want to thank, right? Specifically Wayne McDowell. Cool. Thank you for misspelling my name. Anyways, so actually the funny thing is, this is they rewrote my report and made a big part of their website. And so anyways, we'll have to find it on FX Street somewhere. So what happened was I wrote the report and they thought it was amazing. So then they got all their other experts together and they even built a part of their website to support the data. But it was definitely me who wrote it. Let's see. Here it is. Okay. It's funny that it doesn't pop up. Here we go. Here's my report. Yeah. All right. Hey, this is interesting. This screenshot here, this is from my first iteration of QuantBox. No, TradeRs. It's actually, well, I had something that was a combination of QuantBox and TradeRs. And this gave me the volatility of non-farm payrolls events, well, all economic events. And that was really interesting. It gave me average volatility spikes in the first 5 minutes, and it was pretty interesting, but I can't find it anymore. Copies of that software that I had. But anyway, so let's just get to it. This is how you build your model. I was asked they want a new photo. Why? Look at that. I was Speaker of the Year back in 2016, huh? Yeah, well, that was a while ago. Best Forex blog, best Forex webinar, best educational webinar. Nice. Good for me. Keynote speaker at the ITC in 2007. Yeah, I took my daughter and my wife to that one in Barcelona. Interesting. I'm an advisor to Georgia Tech, but I'm not on that board anymore. I mean, I am, but I'm not. I am, but I'm not. I don't really do anything. But I'm on a different board. Interesting. And that is true. 1995, sat on the board with George Soros. That is true. Ooh. All right. So there you go. There's the link to that. So anyway, so nothing's actually changed if you look at our strategy here on the 4-hour chart. For retail traders, there's like, oh, euro's all over the place, and for institutional traders, euro hasn't done jack. It's just sideways, but we're riding the moving averages, and maybe going to go from 110 to 120. Okay. And we're just stuck here. If you go out to the daily, you know, it's a mess. But we are trying to head up. We're riding the moving averages. So you can see it's very, very, very basic on a daily chart. But again, retail traders don't have the kind of patience to just say, let's make this a little bigger. Retail traders don't have the patience to just say, okay, we made a higher high, so it went all the way up to here. Okay, so now you just go like this. Okay, and you set up the role reversal off of, okay, next week's pivots, or next period's pivots, okay? And, you know, it's simply buy the dip, take it north. It's very, very, very simple. Retail traders don't see it. They don't do it. I'm not sure why, huh? They prefer the small time frames and volatility. Okay, so I guess it's time to bid you adieu. The quick buckaroo. But you know, every person on the planet for thousands of years that tried to get a quick buck failed. They died broke. Okay? It's strange, isn't it? And then you talk to like wealthy families and you know, let's say they're heavily involved with like real estate. The slowest, most illiquid buckaroo you can get. And then you ask them, what do you do all day? And they're like, I collect rent. How long have you been collecting rent? Since my granddaddy bought the land. And then my daddy. And then me. My little buckaroo. We collect rent. So that's all you do. You don't do anything but collect rent. That's it. So wealthy people are about the slowest, most boring buck in the world. There's no quick buck. Okay, I was going to end, but I just got an email just right this second. It just popped in. It says 3 minutes ago, but I just saw it pop in. Take a look at pound Kiwi down. All right, let's go look. I I don't have that on my thing. I guess we'll do Kiwi. Pound Kiwi, pound Kiwi. All right. Let's see. Where do you talk to me, Goose? Ooh, that looks like an inverse head and shoulders to me. But okay, this says maybe a down. And it's looking at a breach of 206 or a 206.32 and drop for 20 something pips, really? And so it's saying it just popped up. So yeah, it's thinking that, huh? And a take it down scenario. I suppose I'd be worried about the inverse head and shoulders, but I suppose it's doing one of these things. So what's it? What's the target? See, it's just a scalp. This is a scalping alert. 106.10. Yeah, that's about right. Yeah. $206.32. 206. So I this would be better up high. So this is, so you know, if you did it now, let's just do it for fun. Okay, we're at 60. And it says we can get down to 10, maybe. See if I go back to this, maybe even through down to 80, 58. And yeah, so if this one works out, I could probably pick up more like 50 pips. And what am I risking here? 30. Now, my concern, of course, is this way. Okay, that would be my concern, but that's a higher time frame, right? And I suppose the head and shoulders, the inverse head and shoulders forms if we don't make a new lower low, and I think, right? And then that sets up sort of a new direction. So this is like the last hurrah. Okay. Oh, what do you mean by future version? Yeah, if you don't have traders already, it gives you a sweet ass, deal to get involved, because I want you to know how to use the tools. So it'd be like, here's the tools, you can play around with them as you learn, so it makes sense. So it's like, this is a neat little scalp, and its failure is also informative, huh? And its number was 30, which is interesting because the alert came out at this number, and it said, look, a breach below this is a big deal. And then, remember, the alert is the alert, but how do you trade? You sell highs. So the alert came out, and it already moved the up part. So the thought is you can take it down, put the stop here, and, I'm short at 50, not 30, so I get the extra 20 pips, which is nice. Oh, Pound Aussie came out as well. Let's see. Yeah, that just came out as well. But, basically it's the same thing, right? So this just arrived 1 minute ago. And pretty much the same thing, right? But maybe you like this one better. Oh, Abdul says, I really want to get understanding on integrity. Oh my God, will that be drilled into your brain, Abdul? Summer camp. Oh my God. Yeah. Yeah. If that's what you want, that's what we're going to do. You just defined it. But the thing is, what most people are lacking is even when they have the integrity, they're not pulling the trigger. They're just not doing it. So that's the other side of it is, okay, how do you analyze the market? In particular, not just integrity, but another problem that a lot of people seem to do is they trade at all the wrong times of the day. So it's like, how do you take the integrity, mix it with price action, mix it with the market open, and actually do the trade? And summer school this year is heavily focused on doing the trade. Right? London. Right? New York. Doing the trades. London Open, New York Open, do the trade. What's the trade? Let's do the setup. Abdul, set it up. Take us through. What's the direction? What's the speed? Where are we going? Where's support? Where's resistance? At what level are we going to pull the trigger? Okay, now let's do it. Okay? This is truly a boot camp, not a lecture series. It's not Harvard. It's crawling through the mud and pig guts on your tummy with barbed wire over your head and a drilling sergeant screaming at you and firing off his weapon. Okay? Okay. Yeah. Pretty hardcore stuff. You're going to learn how to trade. All right, so anywho, Nito, if you're interested in these emails that some of us are getting as a way to like, they're whispers. It's traders whispering, hey, you should go check this out because something is happening. Now, they're just little scalps, right? They're just scalps. Like, it's forecasting 26 pips. It might move more. But, 70% chance of 26 pips. And then you saw, like, the Kiwi one was about the same, but I sold it higher than the alert. So I get closer to 40 or 50 pips on mine because I had a good entry. Neat. That is an upgrade at TradeRs. And I'll show you where that is. In case you're like, dude, those emails are interesting. Yeah, they are. And the thing that's interesting about them is it's not an alert. It's not a trade alert, right? Everyone's looking for signals. No, I'm going to make you a good trader. If you're looking for like signals to make you rich, I'm not going to sell that to you. If you want to be a good trader, okay, let's develop a relationship. So what it's doing is it's looking for, forecasted similar potential market moves of at least 20 pips. Okay? They're similar patterns on. Now, usually you'll get one on different time frames. Okay? And this one's the same time frame. So maybe that's not that great. Maybe it's okay. But it's like, go check this out because multiple things are happening that say the same thing. And they both predict the same thing. And then when you look at how successful rising wedges are, and breaks of support, when you look at how successful those are and you combine the probability over the past periods, yeah, there's a pretty high chance that you'll get a little scalp out of it. It's right. But it's the fact that it's multiple things going on that say the same thing, and it just points you that direction. So anyways, so if you like that, as right, what you do is you subscribe to the plus. Okay? And then it says these alerts are available option here. Not here, not there. So you can add that on, and it's like, I don't know, 82 cents a day. I just got 2 heads up. You know, it's a time saver. Okay, but it cost me well, let's just say it cost me a fair decent amount of money, we'll put it that way, to send this to you, to develop it, to automate it. You know, it took 2 weeks of development work to build it. It cost me, even if I don't send any emails, if nothing went out, it would cost me several hundreds of dollars, even if I don't send anything out. So I think 82 cents a day is pretty fair. It's not like a money maker, but it's to cover the cost. But now if I send out, 2 or 3 of these a day, I'm getting charged, right? So, it's truly like, if you want this, it probably cost me 82 cents a day to send it to you. Cost 82 cents for you to receive it, and everybody's happy. Yes, it does, Bernd. Yes, it does. I'm developing a presentation to go over those numbers with you, but yes, it does. And are you able to view them? Yes. So what did I do with it? Where did it go? I guess it's here, huh? It's right here. Okay, you can go back through all the different markets, Bernd, and go through the patterns. Okay, you can do all kinds of things. Break it down, time of day. Okay, when certain patterns work, when symbols tend to work or not work. Okay, the patterns and their success rates, and you break them down by indice, right? So you can do like Forex, and yeah, ascending triangles 335 times, 579 correct, 69% accuracy. Yes, Bernd. Yes, it's a level. It's the degree in which we have data through TradeRs is just like second to none. It's incredible, Bernd. Yeah. Is summer camp over now? No, it's starting in 5 days. Yeah, got hung up on your Gmail server? Yeah, that can happen. Yeah, they're all sent, right? They're all sent at the same time. It takes maybe 30 seconds to send everybody the email, and the rest is up to God at Google. Yeah. But they get sent. Boom. Yeah. All right, so I just have to do my little job here. Simple little job. Good. Now I've planned the future. Yields on the 10-year T-note are currently at 4.29. That makes me so happy. Little comeback on gold today. Or I should say oil, sorry. I'm looking at oil and I called it gold. How does that work? So we had the... Oops, if I move this... Oh, it's not going to let me, is it? Anyways, I'm trying to grab that, but I guess we'll do it this way. Okay. So we had that nice little move. We're back to game on. Everything is right as rain. How lovely. So I own quite a bit of the S&P 500 in my retirement account. How much is it? Like 50, 60%? I think it's close to 60% of my pension fund is in the S&P 500. Cool. So that makes me, right? Well, Bernd, that's a possibility. That might be able to be done. The thing is, Quantbox was first. But I get text messages from Quantbox all the time. I got one at 9:02 a.m. today. And it said, dude, check out euro dollar up. All right. And that was after the ECB, right? After, where's my euro dollar? Okay. And it said, check out the euro dollar up. The technical trend. So it noticed the spike. So what I can do is a trap and break. Of course, you know, I do this over and over and over again. I can do a trap and break, drop into a smaller time frame and just wait. Cheaper. I don't know about cheaper. But yeah, the interesting thing about the text messages is I get billed every day. So every time you get a message, I get a bill. And I'm like, oh my God. Yeah. Yeah. I get these bills. I'm definitely not making money on that feature either. I'm probably losing money still. But Quantbox is great because it notices why things are changing. Tradars doesn't understand why. It just says, hey man, I see a pattern. And this is where people like that are looking for I don't know, an alert to make them money. People that look at traders like alert are not going to survive they're already failing. And I don't think there's anything I can do for those that are choosing to fail. They're like, oh, I'll subscribe and it'll make me money. No, it's for traders, not followers, for traders, right? So anyways, how do I say this? We know that this is, okay, a pattern, right? And traders, what it looks at is, okay, oops, I wanted that in yellow. I guess now it's too late, but okay, there's something going on. But because it's not an alert, it's a pattern recognition system, what it's telling you is this is got a reasonable probability in the pattern of rising. So it'll tell you we're in this process of rising. So what does an amateur retail trader do that wants traders to make all the decisions and make all the analysis and make them filthy, stinking rich? What does an amateur get rich quick person do? Well, they think that's a buy. Why? That's the part I don't understand. Oh, because TradeR says it's going to go up. Yeah, that's the pattern. What I don't understand is it's falling. You should be preparing to sell it. But it said up. Yes! It's going to go up. You should get ready to sell it. It's bearish, for crying out loud. But it says up. Yeah, well, it didn't tell you to buy it. Okay? And then they're like, oh, I'm going to leave. None of these patterns work. Oh my God. Right? So it's telling you where we are inside the pattern. So up doesn't mean buy. If it's a bearish trend, it means get ready to sell. Okay? 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 So anyways, huh? Burns says, okay, Wayne, you always say QB is fundamental, so how the hell does it see a spike? All right. It saw the spike because one of the things it does is statistical analysis. Okay. Okay. And so it'll notice the spike statistically. So QuantBox might be looking at it this way based on, statistical analysis, and then it'll find there's an outlier. Right. And then, okay. Now with Denise's question, the scores change throughout the day. So those that have upgraded to the AI alert service, they get a pre-London and a pre-New York update. And it tells you what changed. Okay. Okay, Kurtz. Yeah. Colonel Kurtz. Yeah, what's happening is if it's gray, it's forming. It's earlier, right? And the second one is they're forming. I guess the next level would be like developing. You know what I mean? Okay, so one is like if it's gray, it's thinking down, but it's early. Okay? And the other one is, okay, now it's the next leg. So imagine there are rules for every pattern. And when do you decide a change of direction has occurred? When do you decide we're in a down channel? And imagine there's sort of like a higher high, lower high. That might get you a gray box. Down and gray. And then if a third one develops, then it becomes a red box. Okay? So earlier and then more developed. And then at some point, it gets moved over to active. Okay? Which is no longer something developing, or what I say emerging. It's no longer an emerging pattern, radar. Oh, we have 30 planes emerging over to the northwest. Well, they're not here yet. They're just emerging. You don't know where they're going to go. They might change direction. Right? Then the next one is, okay, they're active. They're here. It's in play. And that's how we make those determinations. So sort of like earlier, close, and then on top of us. Okay? All right, guys, I got to go. Peace on earth. May the pips be with you. May your profits be above average. Have a wonderful day. Okay? Remember, there's Trader's Way. Investor Boot Camp, we're meeting today in the swing trading group. Yesterday, there was a meeting in the swing trader group. The day before, there was a meeting in the swing traders group. Wow. You should become a swing trader. There's Quant Box. Luftly tell your mom. Okay? If your trading isn't organized like this, you are not trading properly. And then a lot of the questions today about traders, which I'm going to use to take over the world. I'm going to make a huge difference with traders. I'm telling you, this is going to be the culmination of my life's work. And I want you to succeed with it. And so this is what we're talking about. Radars, the scalpers. Okay. So this used to be called active. That's why I called it active. But I realized the way that it's working is based on like the gray arrows turning into red arrows and then moving into here. What happens is there's not a lot of meat on the bone because you're like, Wayne, give me a Forex trade with 75% accuracy. Okay, they exist, but there's not a lot of meat on the bone because you waited so late. But they are, but I'm like, look, if you're going to pick up 25 pips, it's a scalp. All right, cool. So these are all your scalp opportunities, right? Okay, cool. So they're radars, right? Radar, scalper, sonar, calendar, testar. I know. Have some fun with it. Okay. Grumpy Cat says, Wayne, can you put the quant score on on charts? I'm going to do that. That is on the plan. I'm going to move everyone to TradeRs, so all the quant box data is going to go into TradeRs. Our live trading groups are going to go into TradeRs. So we have coaching, we have analysis, we have fundamentals, we have technicals, we'll have a prop fund. You're going to have everything in one place, and it's going to become a career. Okay. Can we do a special TradeR meeting? Yes. Okay? It's all being planned, Bernd. All right, gotta go. Have a wonderful day. I'll see you later. Remember, tomorrow I'll be at FX Street. Peace on earth. May the pips be with you. May our profits be above average. Cheers. That just happened.